Hello, and welcome to my trade breakdown. So last week we had a couple winning trades which came out really well. Mostly just thanks to both the market and oil prices recovering. We've got the Saudis and the Russians decided to stop their oil war, so that good news came out, boosted oil prices. And then you've also got the market, which had kind of a weird rally over the last week. Now, I protected my portfolio in such a way that I didn't get hurt by that. That actually helped me out quite a bit. However, I was anticipating the market to continue sideways, not rally 25%. So that's almost exactly what I was warning about just 2, maybe 3 weeks ago in my videos before. And thank heavens I structured my portfolio the way I did. As you can see by my deltas, so my SEP, so my IRA is finally getting some of the deltas under control as I'm able to take off some of those losers, taking them off as not max losers, but mostly, and they're still losers, but finally getting my deltas down a little bit and getting the theta back up. And then my delta in my main portfolio is almost completely flat. I've only got 3 positive deltas, 16 theta. That's a decent ratio given that I have no idea what the market's going to do. And I'm only using $3,000 of capital, so I've got a little of extra room to put on positions if the market drops. Now, let's get into these winning trades. So I was trading the first one, we're going to look at OKE. This was intended to be a long-term play. And let's actually just filter this. Boom. So in the last 7 days, let's expand that out to 60 days. Yeah, so here we go. So all my trades in the last 60 days on OKE, that's OKE Energy, or OKE Inc. I've traded this before as a dividend stock. This was my first time trading OKE as option play. And as a dividend stock, the last time it sold for under $30, I was able to buy in, and it more than doubled in value by the time I sold it. And I was just investing as a dividend investor. I did not invest in that with the intent of realizing capital gains. I was after their dividend. This time, with this sell-off, I realized OKE, they are a natural gas company, but their prices matched the prices with oil. And with oil at making all-time lows, it was an obvious buy to me because OKE, from my previous investing experience, I understood, hey, these guys don't make money off of the price of gas. They make money off of the fees for transporting gas. It's an oil pipeline company. I don't typically trade like this, but the prices were just too cheap for me to ignore. And so what I did, I went in and I placed, let's see, this was the April 17th and January 21st 30 calls. So just a straight 30 calls. So let's actually go in. I'll just show you guys. April 17th. So my original opening trade. I sold these April 17th, and then I purchased the January 21st, actually all the way out here. So I purchased these for $275. So if we just pop back over here, and this calendar, what this does, the IV, if you're looking at the IV here, I sold the IV at a much higher rate. This is actually 141. It's still really high right now. And I was buying options with an IV of only 80%. This created a nice arbitrage opportunity. And at the time I put this on, I was able to pick that up for $275. And now OKE Energy continued to trade down. So let's see, what was the date I put this on? So I put this trade on the 13th of March. So well into the sell-off. So the 13th of March, let's come in here. March 13th. Right about here. Yep, that's right about here. Let's zoom in a little bit more. That way you guys can see what we're looking at. So March 13th, right here. So I put the trade on right here. And as Onio continued to move down, right when we had this rally right here, I believe this is the 19th. Let's look at the activity. Yep, the 19th. So on the 19th, we had this rally right here, and that gave me an opportunity. Oh, it's over here too. That gave me an opportunity to roll to the 32 calls. Now what this does, so let's pop in here. Oh, wait, back to the trade page. So I ended up buying this back. So we're gonna delete this leg. Actually, we'll just increase that in time. Let's see. That was the April 17th, so to the May 1st. So that's the May 1st, and I rolled this up to the 32 call. Ooh, I lost my spot. There you go. Yeah, so I rolled this up to the 32 call. Now this creates a $2 spread, like between my long and my short option. So the long option is still at the 30, but we've got that $2 spread right there. Now the only problem is at the time I did this, let's see, let's look at the open interest. See, look, there's 6 contracts here now. So when I did this, I was the only person to roll into that strike for that expiration. So I had the only contract, and the bid-ask spread, instead of being $1 wide, it was $4 wide. And so if you look at my previous videos, I'm constantly kicking myself for being such an idiot and not realizing how low the open interest was in these weekly trades, because this is a weekly. This is a weekly. If you look at this, so the monthlies, these are monthlies. The 32 monthlies, they don't even have 32 monthlies, but they've got a lot more open interest. So the bid-ask spread is slightly tighter. It's still not great. So I was able to collect another 25 cents, and that reduced the $2.75 that I paid for this trade. So my total at-risk capital in the trade is now $250. That's $2.50 per share. But I have 2 years, and the market just rallied a little bit. So we had some good news right here. And then the game I'm playing, so now that my short call strikes are above my long call strikes, I've created a diagonal, and that trade acts like a covered call without requiring me to put up the money for a stock. And so my plan was just to continue rolling as soon as I was able. I was stuck in that trade as a loss just because of how few contracts were being traded, and I was just going to let that option expire, that 32 expire, whether it's in the money, out of the money, whatever. I was going to let it expire and then try to roll out and capitalize on that trade. Now, thankfully, what ended up happening, I got an opportunity to get out on the 8th. So we've got this multi-day rally right here, and thankfully I was able to get out of the trade for a $5 credit. That's double that $250, which is 100% return. On the calendars, my normal targeted returns, usually I'm trying to get between 10 and 30%. So the only reason I was able to get that is thanks to that rally and how illiquid the prices were and stuff. I simply got lucky. If you actually watch me placing the trade, I actually had to, the price that I was quoted was 600 something, but I actually reduced that to $5 and was able to get out for exactly $5. So just breaking down that trade and my thought processes behind that. The price of OKE was in the 70s and 80s, and this is like trading for, what was this lowest point? $20 is ridiculous. that is absolutely ridiculous. I know the economy is not doing well and stuff, but they're a strong natural gas company, and they've done pretty well for themselves. Honestly, unless it's like they do have a lot of debt, so if their debt load is way too high and stuff, but other than that, this company is a pretty solid company. So I was pretty confident as soon as oil prices went up, their stock price would start to go up as well, and I could profit on those positions. I just didn't anticipate profiting this quickly. So the entire trade lasted for about, let's see, that's just not quite a month. It was like three weeks maybe, from the 13th to the 8th. And then I closed that out for 100% win. And like I said, I wasn't aiming for the 100% win, but I'm very happy to take that. So, especially given how illiquid this stock is, and as far as options go. And then this video is already getting a little bit long, but I did want to look at my other trade. So the other trade was an XLE, and this was a jade lizard, which I put on for 165. I rolled it a couple times and then I managed. Let's review what XLE did. So if we pop in to here, I placed the trade on the 23rd. So the 23rd of March. That's gonna be right about. This is the 24th. Here we go. 23rd of March. Now this trade is a jade lizard. So that means I could not have timed this more perfectly. This is right about where I started to tell you guys, hey, this market has sold off way more than I expected to, and now I was starting to get worried about the market bouncing. So if you look at my previous videos, you'll see, hey, I'm commenting, hey guys, this is a concern of mine that the market could rally. I was expecting the market to either shoot straight up or trades down and sideways. So trading up and sideways is not quite what I was expecting. But anyways, let's just take a look at how I manage this trade. So first I'll show you how I put on the trade. So I put on the May 15th options. So coming in here, and I sold the 18 put, 26 and 27 strikes. So the market was all the way down here. So my call spread was the 26 and 27. There we go. And I sold the 18 put. Now I was able to collect. Wow, I can still collect over $1 with this trade. That is crazy. Anyways, so I was able to collect when I first put this on $1.65. So that $1.65 meant that my profit, just like it's listed here, I profited as long as it stayed above basically, let's see, 1635. As long as this stock stayed above 1635, I would be able to make some money by expiration. So after placing this trade, let's take a look at what the market did. I made 2 adjustments before closing, both of those to the put. So no idea, this is completely coincidental. I just so happened to sell the very bottom, apparently. I put this put spread, this jade lizard on at the very bottom. Market shot up. As we can see, my first adjustment is on the 26th. So on the 26th, I rolled up my puts and collected an additional 50 cents. Now I rolled them from the 18 to the 22. So we're just gonna do that. So I left the expirations the same. So I just rolled it up to the 22. I collected another 50 cents, 215 in total collections. And then let's pop back in here. So the market dipped. And so on the 27th, we had a drop. On the 27th, I said, dude, IV's going back up, market's dropping. This is the perfect time. I can roll up even more and collect more credit. So we got this dip. I roll up my puts again from the 22 to the 24. I collected another 45 cents, bringing my total collection to $260 of credit. So $2.60 per share. And then I just took this trade off on April 8th. So as we see, the market had that little dip and then it shot straight back up, and I was at over 50% profit on my trade. Let's see, 260. Yeah, so that was nearly 50% profit. And that is the point where I said, you know what, I'm gonna just close this trade. The market's up. I'm gonna look for a new opportunity to put on a trade. Next big down move we get. So I managed to take out $122 in profits for that trade. OKE Energy, we've got $250 of profit for that trade as well. So those are just two of the trades that I put on, and just breaking down how I implemented them. Now, my portfolio hasn't completely recovered from the sell-off, just like the market hasn't completely recovered from the sell-off, but I am making back a lot of those losses as IV contracts. The important thing is being able to continue trading through the entire sell-off. And I'm in a position now where I can put on more positions as IV expands, and I'll take more positions off as it contracts and just continue adjusting. So, all right, that's my trade breakdown. I'll continue breaking down other trades for you guys if you guys are interested. So, thank you very much. Happy Easter.